So on the government intervention in Turkey, we wish some of those happens. It is seriously a difficult market on multiple fronts, like I had mentioned. But we only feel that the things can only become better from here on. And with our team very focused on what they need to do, we should see definitely better results going forward. I'm not very aware about this RBI guideline on secured lending. I don't think it is impacting us because our funding is as usual. We are quite okay in terms of the funding. While there is some liquidity issue in the market, but otherwise our funding is not a challenge.
Thank you. It was more on the fact that unsecured loans to end borrowers, because mobile phones are bought on EMI and so on. So whether that had any impact, but I guess it's not so significant. And like you said, election is the bigger mover for you. Thanks a lot, and wish you the best.
Thank you.
Thank you. The next question is from the line of Kushagra from Old Bridge Asset Management. Please go ahead.
Yeah, hi. Thanks for the opportunity. Few questions. One is on the strategy or the capital allocation front. If you can help us understand the way you think in terms of the levels of debt which you are comfortable keeping on your balance sheet. Because the way I see this is the balance sheet strength is superb. Your net debt levels are same as it was 13 years back. And the working capital management has been superb. So keeping the working capital days same, are you thinking of avenues of taking a little more debt and probably grow a little higher, and without compromising on the quality of the business or without compromising on the quality of the balance sheet? That is one first question. And how should I tie up this with the comment you made on the Turkey debt and the transaction which you have done to reduce the debt in Turkey and hence reduce the overall impact of the higher interest rates? So blending the two, how should we think about the debt levels you're comfortable, or how should that evolve over the next few years on your balance sheet?
Okay, so I will answer it first for the rest of the markets and specifically about Arena. See, we are very focused in terms of return on capital employed. Anyone in Redington, you ask ROCE, they can tell you what ROCE means, how it needs to be calculated. So we are so focused on that. So we will ensure that our debt equity, our internal comfort is between 0.6 and 0.7. And that's something which we are quite comfortable. And with the current debt equity ratio, we think we have sufficient capital for any spike in the future growth. Subject to, as you had said, the hygiene factors being in place and the return ratios are the thing being maintained. In the case of Turkey, it is first of all, you need to know that we don't hold 100% in Turkey. This is the only company within the group which is not 100% held by us. It is less than 50%. But we have the board control and it's a listed company. They have a little bit more debt, and that was on account of the acquisition that was done about 2.5 years back. And at that point in time, the market was quite okay, and it has got deteriorated only in the last 2 years. We think with this divestment that we have done, it should give us significant relief in terms of our debt equity ratio. And there again, ROCE is something which is fundamental for us. I'm not sure whether I've answered your query, Kushagra.
Yes, sir, you have. All right. The second question is on, again, a broader related to Apple. So Apple has been consistent more than 30% for you. And if we try to map Apple India sales with and try to sort of back calculate Redington's wallet share, it has come down. So can you tell us how the distribution channel is divided for Apple between different players, and how should we see this evolving? Because I think there could be some certain conscious calls as well from your side. So how should we see this evolving in the way that now Redington's wallet share should remain constant and you're hooked on to the Apple's India growth for you? How should one see that?
So Kushagra, we don't make specific comments about a brand, but I can tell you, see, the brands decide how much they want to go direct and how much they leave for distribution. It's really their call. But what we do is then there is what is called as a DTAM, the distribution total addressable market, and we try to maximize when we play in that because we want to remain number one or number two so that we're relevant. It's very hard to comment specifically about a brand in a call like this. So I'm sorry, not able to answer the question directly, but we will maximize the DTAM available.
All right, sure. I just have one or two questions on data, quick ones. So one is if you can call out. So you called out factoring and interest together. If you can call out factoring cost overall for FY24, only factoring cost, and also if you can give some color on the Turkey numbers in terms of how big the revenues are and how profitable it was in FY24. Yeah, those were my questions. Thank you.
Okay. So the factoring cost overall for the quarter is 79 crores. This is 48 crores in Q4 of previous year. Second, Arena is about 10-11% of our total business. For last year, our revenue in Arena in Indian rupees is about 10,200 crores. And for the quarter, it's about 2,400 crores. So roughly about 10-11%.
And how profitable Turkey was in FY24?
We should feel happy if they are making profit at these interest rate, Kushagra. They are making profit. That comfort we can give you.
Sure. And lastly, factoring costs. Okay, I'll sum it up from all the quarters. Thank you. Thank you and all the best, guys.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we will request you to rejoin the queue. Thank you. The next question is from the line of Prolin Nandu from Edelweiss Public. Please go ahead.
Yeah, hi team. Thank you for giving me the opportunity. I have 2 questions. One is on the Africa and Turkey business. If we look at FY25, is it fair to comment that maybe the worst is over for both these geographies, and this can be a good base on which we can see growth in FY25?
Yes, I think so. I think we definitely see some positive signs. So let me just start with Africa first. We are beginning to start doing business in South Africa, which is a little bit more mature and stable. We just started in the last couple of quarters, and we have some reasonable plans in the coming year on South Africa, and we've signed up several brands, and that should help us grow the Africa business. Egypt is also, with the IMF injection and everything else, is getting stabler, even though the currency is volatile there and the interest rates have gone up. But the ability to do business has increased. So those 2 markets offer potential. I think Nigeria continues to be stressed. There is improvements in Kenya. So I would say all in all, directionally, for the year, over the next several quarters, we are a little bit more optimistic on Africa. So is it with Turkey. 2 things that we see, as Krishnan mentioned as well. So as and when PayNet unlocks and the deal is consummated, post-regulatory approvals, definitely our ability to show profits as higher profits and to go after new business will be better. Also, we are hearing from the market that there will be better improvements in interest rates and inflation. But again, this is all based on economists and other people that we hear. So we think that the Turkey environment over the next few quarters should also improve. The currency, if you look at the last 1 year, The currency devaluation has been not as tough as the previous years, so we are hopeful in Turkey as well.
Just to complement to what Hari said, the 4 markets which Hari mentioned, I'm just calling out what is the depreciation in FX the last 3 months between December 31st and March 31st. In Kenya, it appreciated by 17.7%. You all know what is our EBITDA margin, 17.7%. Previously it was at 132. From there it moved up to 156 and then dropped to 133. In Nigeria, it got depreciated by 27% in 1 quarter. In Egypt, it got depreciated by 34.8% in 1 quarter. Please understand, in some of these markets, there are no proper hedging mechanism available. And our business model has a natural hedge built into it. But if the customer or we are not able to get dollars, which is what is the situation in countries like Nigeria, there is a big risk, and we need to be careful in that.
No, thanks a lot. That's very clear. The second question is slightly more on a strategy level. So if I look at your top 5 vendor list, right, all of them are hardware companies. In our 2 segments like TSG and CSG, we have an element of software as well, right, in terms of cloud and enterprise solution. And both these segments have been quite robust in terms of growth. Right. So how soon can we see a software company in your top vendor list? Is it 5 to 7 years, or will it be sooner? Will it be later? And from a point of view of selling software versus traditionally selling hardware, in terms of aligning the organization towards selling more software, go-to strategy, what needs to be changed? What has changed, and what is the competitive landscape? In the past call, you have mentioned on the margins are pretty much similar for hyperscalers, right, and maybe slightly higher for SaaS. But when it comes to ROC, is it meaningfully different from your hardware business?
All right. So we are also very hopeful that we will see some of these hyperscalers / softwares that we resell through the TSG business get into the top 5. I don't know. I would hazard a guess maybe it will be in the 3 to 4 year time frame. But we are seeing definitely good growth. I would say overall in our business, the subscription piece has become more than $1 billion between the hyperscaler piece as well as the TSG platform as a service and the software as a service piece. The additional opportunity that we see is to appropriate and professional services. So in the cloud space, we do resell, and the resell part, as you rightly said, the margins are very similar to hardware. But the associated part is professional services where we provide assessment and migration. It's still a small business, but much higher gross margin. And we're beginning to learn and work on that, and we will work on this partnering with our reseller community, specifically focused on professional services. I think this will take time, but this can result in a higher margin, higher EBIT profile. I think ROCE might be similar because there will be investments we'll have to make on OPEX in this kind of a business on people. But definitely there is increased focus on how we can organize ourselves. We are investing in a cloud platform called Cloud You already know that. We are already investing in a kind of a marketplace where we bring ISVs and MSPs and CSPs, ball and cloud players together, so we can create an ecosystem, so we can go faster at it and also try to appropriate some of the services and build competencies internally. So there's a number of activities that we are doing that will enable this to happen. We are already organized well, I would say, within the TSG team, the Technology Solutions Group. We have a software sub-business unit, and we also have the cloud unit as a separate unit. So we are largely organized well, and we continue to focus and invest the right way to get the best ROC.
Sure. Can I ask one more question, if that's fine?
Yes. Yes.
Yeah. Can you touch base slightly on the competitive landscape here in both your TSG and CSG business? And where I'm coming from is that there are traditional players who have been quite strong here, Plus, there are some telcos also who want to venture into this kind of an opportunity. So when it comes to competitive landscape, is there any white spaces in terms of the way we are offering these services, which is different and through which we are able to fill that white spaces?
Yeah, very good question. So, firstly, I'll start with the cloud space, the hyperscaler space. Within the hyperscaler, clearly resell is a somewhat easier thing to do, and many of our peer distributors, IT distributors, do similar thing. But where we differentiate or where we have come in is to really drive our understanding of how to drive consumption and workloads and how to drive the professional services around assessment and migration. And these are not done by system integrators and not well understood by our peer distributors. So we try to differentiate and taken a kind of a lead space there. In fact, I would say in India and some parts of MEA, particularly UA and KSA, the key hyperscaler partners really appreciate what we have done, and we've become a larger distributor and kind of a role model and an example for some others to follow. Within the technology solution space, again, there is a whole lot of brands that we work with on platform as a service and software as a service. Again, I think there the adjacency of being able to value add on professional services and implementation service and working with resellers is probably the differentiator. There, however, we find a lot of the value-added distributors or value-focused distributors are also there, and we'll have to learn our way and compete better with them. But clearly, I would say in the hyperscaler space, we are having a leadership, and the ability to have our own cloud platform combined with this ecosystem that I talked about is going to hold us good longer term, because we are not behaving like an SI. We are behaving like a distributor and building this ecosystem.
Great. Thanks a lot for this and all the best.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we will request you to rejoin the queue. Thank you. The next question is from the line of Drashti from Thinkwise Wealth Managers LLP. Please go ahead.
Thanks for the opportunity, sir. When I look at our overall growth, our MSG segment has declined by 12% quarter-on-quarter, and TSG has also declined by 5% quarter-on-quarter. So when our working capital days have improved by 2 days, from 36 to 34, I wanted to understand, is it because the MSG growth has been lower, which is why we've seen improvement in the working capital days, or is there anything else, anything structural that we've done because of which we've got this efficiency, and can this continue going forward? Although you've guided for 35 to 40 days, but 34 is a very stark improvement. So is there anything structural that we've done in the working capital or to improve the working capital is what I wanted to understand.
Efficiency. That's a buzzword. We are trying to do as better as possible without compromising on the growth. And the point that you mentioned in terms of MSG and TSG, it is more. What should I say? In MSG, as Hari said, a quarter on quarter between Q3 and Q4 may not be an appropriate model, because Q3 is the time where you find all the vendors announcing the new products, so there will be a spike in Q3, and hence that's not a correct way to look at it. In TSG, as I've said, because of some postponement that had happened in India due to the elections, in Africa, our conscious decision to be careful about the risk has resulted in the degrowth. It is nothing to do with our working capital.
No, exactly. That's what I wanted to understand. Is the working capital improvement because the MSG, obviously because of the seasonal business that MSG has gone away, and the TSG, main is the TSG has declined quarter on quarter, because TSG requires a working capital, right? And that is declined year on year as well as quarter on quarter. So is the working capital improvement because of that, or like you mentioned, it's efficiency in the business is what I wanted to get an answer on.
So this particular quarter, most improvements have actually happened in ESG and TSG, and it's not on account of MSG, the working capital improvement. MSG always is quite light on working capital, and it's a fast velocity item. But I think to answer your question, I did mention it in my opening remarks, we've actually put some additional focus. We've organized ourselves within both the geographies to have a more intensified operation focus between business operations, sales operations, credit and collections to really focus on working capital. Now, can we maintain 34? That's a different question. Our guidance is still to be between the 35 to 40 range. But the improvement starkly has happened in the ESG space and a bit on the TSG space. These are the two business units where our biggest improvements are.
I'm just reading out, Drishti, the earlier point that I mentioned, the other players in India, DIO, inventory days, 31 days, 52 days, 52 days, 33 days, other players. We are at 24 days. DSO, AR days, 59 days, 63 days, 39 days, 43 days, we are at 49, right? So we are trying to be as good as possible in the ecosystem. If others go berserk, then we also need to accordingly manage the show.
Got it. And in your opening remarks, you've mentioned that the new brands we've focused on adding new brands. And when I see the other segment, that is also improved for us on a yearly basis. So if you could highlight on what brands have you added and whether the margin profile and working capital profile are similar to our existing business. And in which segment have you added these new brands? If you could highlight something on that.
So a lot of it is in the cloud space. So you'll see brands like Zoho that got announced that we're partnering with, SAS. So there are many brands like those we are adding and partnering. A lot of these brands used to go direct. And as the cloud space is evolving, clearly they want to work through the distribution model better. And we continue to add many, but I'm just giving some examples here.
Okay. And so when I look at our employee costs of standalone business, which is standalone business versus the rest of the world, our employee cost as a percentage of revenue in the standalone is around 0.6 and has been maintained at that. But when I look at the rest of the world, it comes to around 2%, and actually year on year it's increased by 2.16%. So is there a difference in the structure of these employees or organizations in the standalone versus the rest of the world, which is leading to this difference like 0.6 and 2%? If you could explain that.
Each markets are different. I don't think we can compare it that way. But still, I'll give you a perspective. To see the gross margin, I'm just making a reference just to answer your query. Our gross margin in CISA is 4.98%. Our gross margin in rest of the world, including Turkey, is 6.88%. So there is better gross margin. Obviously, there will be a better cost. Incremental cost also.
No, actually, Krishnan appreciates it. But why this question comes is when we look at the newly listed competitor which is coming, their employee cost is almost 1.4% and ours is 0.6, which is why just wanted to understand why is ours so less and what is the structure and why is theirs so high? Okay, so not theirs, but if you could comment on our employee cost.
I think ours has been the steady state at these levels. We are quite comfortable with these.
Okay. Thank you.
Thank you.
Thank you. The next question is from the line of Krish Mehta from Enam Holdings. Please go ahead.
Yeah, thank you for taking my questions. My question was just on getting the inventory and accounts receivable provisioning number for this quarter as well as for Q3.
Okay. Just give me. Sorry. Okay. So inventory provision for the quarter at a consolidated level is at minus 0.21%, and bad debts at 0.12%. When I say minus, it's reversal net. Oh, sorry. This was for last year. Extremely sorry, Krish. For the current year, it is minus 0.41% inventory, and bad debts neutral. There is no specific provision for the current quarter. For the full year, if you see, it is minus 0.1% inventory and bad debts 0.07%, 7 bits.
Okay, thank you so much.
Thank you. The next follow-up question is from the line of Aejas Lakhani from Unifi Capital. Please go ahead.
Yeah, so thanks for the opportunity. I got dropped off, in my last question. So I just wanted to understand the demand environment, both on the enterprise segment, the IT, consumer IT segment, and the mobility segment. X of this election, deferment that is taking place. But how is the overall demand outlook?
So let me start with the enterprise segment. Clearly, and I think your question is more with regards to India, I guess. So the enterprise segment, the demand continues to be very strong, and we are quite bullish in the next year as well. As I mentioned, both our Q4 and our Q1 has been softer because of the elections and postponement of capital decisions, both in corporates and government. When it comes to mobility and the consumer segment, clearly consumer segment, we've seen an uptick in the last quarter. And we will continue to see that as AI-enabled PCs are being launched this year and AI-enabled workstations by all the brands. On the mobility segment, we are again waiting for the NPI to see a good growth, but it will be stable. So we see upsides definitely on the enterprise segment as well as the consumer segment.
And so could you call out the same for global markets as well for ROW?
Sorry? Can you repeat that, please?
So could you just call out the same enterprise as well as mobility outlook for ROW for the rest of the regions?
Yeah, it is similar. So again, I will talk about markets outside of the stressed markets. So Saudi Arabia, UAE, and what we call as rest of Middle East, which is some of the smaller markets around UAE, like Kuwait, Qatar, and similarly in South Africa. We're quite bullish about the enterprise segment in all of these spaces. Within the consumer segment, we also have what is called as an emerging business outside of PCs in the Middle East, where we participate in things like gaming and several verticals, surveillance cameras, etc. Both PCs and those segments we're quite bullish on those for the rest of the world. Africa is where, because of the currency fluctuations, we're just cautious and careful. We do expect Egypt also a better opportunity in the next couple of quarters. We had completely pulled out of the consumer segment in Egypt as the currency fluctuation is happening. We are going to go back and re-engage and play cautiously, but we do expect more business to happen in Egypt in the next few quarters.
Got it, sir. Thanks so much and all the best.
Thank you. The next follow-up question is from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah, hi. Thank you for the opportunity. So considering this is like the annual, would be great if you could give some sense on the contribution breakup for Africa, Turkey, India, Saudi Arabia broadly. So that's one. And second, in the context of what you explained, it looks like, Turkey growth, you would want to push the pedal only once the money comes in, post the approvals. And Africa, again, I think is something like that. So does it look like, from where you're standing, does it look like this year is going to be a little more tail-ended from a growth perspective overall? And do you think that so that's one. And second, do you think that double-digit growth in the context of where the economy is, it's still there for fiscal 25, or do you worry about that? So those are two questions on the revenue side. And on the margin side, do you think margins have sort of bottomed out from on a kind of considering where we are for the quarter? Do you think margins have bottomed out? And I'm saying excluding the other income. And do you think that at least in the first half, considering we're going to be risk off, basically the other income will take care of it, and then the excluding other income margins actually begins to pick up only in the second half. So those are my questions. Thank you.
Let me try and answer the growth question first. I think what we've done in the last few quarters, we've kind of bottomed out. I think the way we have approached the whole environment is maximize investments and growth in growth markets where we can grow profitably, which we have talked about is India, Saudi Arabia, and UAE. And we are beginning to now look at new markets like South Africa that I mentioned, which should yield results for the next few quarters. Clearly, anything from here is positive because whether it's Turkey or whether it's the stressed African markets or Egypt, all of those, we've gone to a lowest baseline, and we should only improve from here. So I don't know whether double digit or what, it will depend on what the market environment is and what we can do. But in terms of our growth, we will only get better from here in terms of whether it's sequential or year on year, but it's what the market has to offer. So Africa, whatever business we thought was risky, we have already traded off, and things could get better from here. In terms of gross margin, you have a question.
Yeah, before that, on the other thing, contribution part, Nitin, overall, India contributes about 47% to our revenue, Middle East and Africa 40%, the balance 12%, it comes out of Turkey. That's the split. Within Middle East and Africa, if you split that further into KSA, which is an important market, as I mentioned, that contributes about 30%, Africa about 20%, all these rough figures are plus or minus 1 or 2%. Rest of Middle East, which in Qatar and other markets, the balance 50%. On the gross margin, I think, we would want you to understand, we have been talking about normalization post-COVID, and this was...
I was talking about the EBITDA margin, right? So when you speak about EBITDA margins, you usually you're actually speaking about EBITDA, which includes the EBITDA margin, which includes the other income. So there is always this moment wherein when we are risk off, basically we generate more cash, and you see higher other income. And then when we're risk on, obviously it moves up into working capital, and thereby the excluding other income margins start moving up. So the question was, excluding the other income, EBITDA margin, do you think that sort of bottomed out on where it is today? And from here on, do we start seeing things improve? Yeah.
Okay. First clarification, Nitin. Our other income is not out of business. That period of we sitting on cash, putting it in deposits, making money, was those 3 years of COVID, right? As you know, we have debt all the time. If at all, if there are any float excess, is what is getting deposited, which is very minuscule considering our total scheme of things. Other income mostly comprises of interest income that we collect from our channel partners, because see, assume we need to give them 60 days credit, we decide to give them a 90 days credit. So that also has a component of, working capital, right? So we do consider this as part of our margins. We think that overall margins have stabilized. This can be considered as a steady state margin going forward. If at all, with the services focus, it can only become better.
Sure, that's very helpful. Thank you so much, and all the best.
Thank you. As there are no further questions, I will now like to hand the conference over to Mr. Hariharan, Group CEO, for closing comments. Over to you, sir.
Thank you, everyone, for joining in the conference. And as we have said, that our focus continues to be on profitable growth and return on capital efficiency. And we'll continue to make sure that we maximize the business in the market and not lose any share with the focus on profitable growth as well as return on capital efficiency. And as I also said in my opening remarks, we do have a board meeting coming up in June where we'll discuss and decide on the dividend. And as soon as that is done, there will be communication to the market. Thank you so much.
Thank you.
Thank you. On behalf of Redington Limited, we conclude this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.